most active funds underperform their benchmarks. Most hedge funds fail. So how come a few people have been able to so drastically outperform everyone else? I pulled together examples of some of the most legendary investors. Some who have played slow and steady, spending a lifetime of reliable performance to get to the top, while some took massive high-risk swings and knocked it out of the park. This is a collection of the stories and the methodologies, the philosophies behind the people who have been able to be enshrined as the legends of investing. Stanley Druckenmiller was born in 1953 in Pittsburgh. He went to school at Bowdoin College where he earned degrees in English and economics, and as a student he experienced business firsthand. He ran a hot dog stand, and there that very simple business would give him insights that would help for the rest of his life. He began working in investing when he got a job at PNC working as an oil analyst. And we can be pretty sure that he was really good, because when he was just 1 year in, he became the head of equity research, and only a couple years later he started his own investment company, Duquesne Capital Management. Still in his 20s, not long out of school, he's become the head of equity research at a substantial bank and started his own firm. Clearly this guy's onto something. And only 5 years after that, he becomes the head of the Dreyfus Fund. And it is not long after this that he joins with an investor that we've already seen, George Soros. Now, people have a whole lot of thoughts about George now, but who was he then? He was the money wizard. And George was looking for a young guy to come join in a very substantial role. Someone who he could train to be like him, and someone who he could bounce ideas off. And Stan does spectacularly. He's the real driving force behind the infamous pound trade, where they went long German marks and short the British pound, earning George the title of the man who broke the Bank of England. Stanley Druckenmiller is a very global macro, grand systems thinker, and one who made huge amounts of money doing so. However, by the year 2000, that track record had started to fade, and he had begun taking some serious losses. He left Soros wondering if he just didn't understand what the market had become, whether the environment was just too different than what he had learned in. He did stay active in investing though, spending his time entirely at Duquesne. Over the years, he began to grow tired of managing outside capital and all the stress that came with that, and now runs the Duquesne Family Fund, managing only his own assets. Something so remarkable about him is that people talk about George Soros' massive investment success, but a lot fewer people know who Stan Druckenmiller is. He was a massive contributor to Soros' success, and Duquesne on its own has had phenomenal performance. His investment strategy is a little difficult to put into a box. It is very big picture, often psychological, very complex systems oriented. There's a real social component to it that looks at the entire world, looks at global economies, trade, the large trends that change how the market fundamentally operates. He's a completely unconstrained investor who will go long, short, use derivatives, go into commodities, all sorts of strategies, whatever allows him to take a position in the outcome that he believes is likely or inevitable. He's still an active player today, although not managing outside capital, but he still speaks, and he's very worthwhile listening to. I know certainly from my vantage, he is one of the people that, when he speaks, I listen. And I think pretty clearly he's one of those guys that we could count as a market wizard. Paul Tudor Jones was born in Memphis, Tennessee in 1954. His family had long been in the news business, his father at one point being the editor of the newspaper The Daily News. The importance of writing was heavily ingrained into him from very early on. He studied economics at the University of Virginia. However, his entire time in school, he still spent a lot of it writing. After leaving school, he went to work with Eli Tullis as a cotton futures trader. It was around this time that the futures market was having a great burst of energy. Unfortunately, one day Paul fell asleep at his desk and was fired. The way he describes himself at the time, he seems like a pretty fun guy. But not long after, he became a commodity broker for E.F. Hutton, and by 1980, he started Tudor Investment Corp. And Paul's another one of these really interesting figures who's very unconstrained. There's no way to exactly nail down his strategy. He would trade global macro strategies, futures, fundamental investment strategies, venture capital, emerging markets investments, derivatives, anything. And all the while, his experience in futures, right when it was getting this new burst of energy, gave him a pretty steady edge. He was a fantastic trader who thought very much of momentum. His focus on momentum is very likely because he developed that while being a futures trader, and he brought that futures trading mindset to other investment strategies. Now, he's a bit of an odd case on this list because instead of being a very fundamental trader or concerned with broader social systems and economics, he's mostly been a technical trader, at least partially. He brought a real element of technical analysis to his trading. He's still an active investor at his own fund. However, his strategy has become increasingly conservative. Something really notable about him is just how successful he was at that technical momentum element. He seemed to be able to track and have a sense of where markets were going with incredible accuracy. Today, he has also taken up considerable efforts in wetland conservation. In the past few years, he's also appeared notably in news for being a substantial hedge fund manager who has stated that he is long Bitcoin. Paul Tudor Jones is a really interesting figure, and on this list that is filled with a lot of more philosophical and systems-oriented thinkers and a lot of real fundamental, deep-diving value investors, he's a momentum trader, and he's an example that people using all sorts of different strategies have achieved incredible success in the markets. So I can't say what the best investment strategy is, but certainly this one is the one that he has a natural inclination for, and it gave him great success. Yes, I'm going to talk about Jesse Livermore. Is he a great role model and icon to investors? Is he an example of what not to do? Not really either. He's really his own thing. Now, before I get too far into talking about Jesse Livermore's life, it's very difficult to know exactly what's fact and what's fiction when it comes to his life. Much of the stories of his life come from Edwin Lefebvre's book, Reminiscences of a Stock Operator. So I don't know what to call him, but he definitely exists as a legend. He was born to a poor rural family in 1877's Shrewsbury, Massachusetts. By age 14, he left school to farm, but with his mother's help, he just ran away. He got a job posting stock quotes on the board at a Boston brokerage, and there he got his first glimpse at financial markets. He was 14 and had very little money, so he really couldn't trade at normal brokerages, but he could at bucket shops. What are bucket shops? They're sort of like if brokerages were all just gambling, less than reputable places that you could go to bet on the markets. By age 15, he made his first trade, betting on the Burlington and Quincy Railroad, and by 16, he did that all the time. He quit his job and spent all of his time in bucket shops. And as a 16-year-old, he was making about $200 a week. Now, I know we can't really tell what that means in today's dollars going back that far, but using approximations in CPI, that would be about $7,000 today. And by around age 18 or 20, he has $10,000 in profits, about $351,000 today. He's good. He's really good. So good, the shops all start kicking him out. So he starts rotating the bucket shops he uses. He's using disguises, fake names, traveling. But most figure him out, and by 22 there's only one more bucket shop in Boston that will let him trade. When he's 23, he goes to New York to bet on the big stock market for real and turns that $10,000 into about $50,000, or about $1.7 million today. And he does this in 5 days. However, shortly thereafter, he makes an enormous levered bet and loses almost all of it. So he borrows money and goes around to bucket shops to win it back. And by 24, he has about $500,000, or about $17 million today. So he just goes on a tear of a bunch of long and short trades. He shorted the panic of 1907, making about $3 million, which should be about $105 million today. He creates an incredibly luxurious, wealthy lifestyle for himself. and a year later in 1908 he gets a tip to buy cotton, which he does, and goes bankrupt. So he goes right back to trading and makes an even bigger fortune, and in 1915 he goes bankrupt again. And around the end of World War I, he's just having fun with it. He tries to corner the cotton market, and the White House takes notice of it, sending the Secretary of Agriculture to look into it and try to stop it. When asked by President Woodrow Wilson why he tried to corner the cotton market, his answer was incredibly obvious: to see if I could. From the years of 1924 to 1925, he gets in a series of trading battles over wheat and corn. He is one of the most powerful market players in the entire United States. But by 1929, he is massively broke again. But he shorts the market again, in time for the Great Depression. But the American people are unhappy with this and call him the Great Bear of Wall Street. He is heavily vilified. And by 1932, he has gone through his second divorce. His son was shot non-fatally by his wife. He was engaged in a legal battle against his Russian mistress. And the SEC got created, which really made it pretty difficult to do what he was doing. So he's not doing great. And not long after, he loses all of his money and goes through his third bankruptcy. By 1939, he sells a technical analysis system, attempting to make money teaching other people to do what he had done. And by 1940, he died at the age of 63, leaving a note behind. So why is he still remembered? Why is the book retelling his life still in publication? Well, because his story is nuts. His life is, and I don't use this term lightly, bananas. Going from one of the poorest guys in the country to one of the richest, to one of the poorest, to one of the richest, to one of the poorest, to one of the richest, to one of the poorest, all over and over again is just, I'll say it again, bananas. So what can we learn from his life? Well, probably something about risk and reward. Next we have Seth Klarman, born in 1957 New York. And this is another one of those guys who you could guess was going to do something like this at a young age. As a kid, he decorated his room to look like a store. He put price tags on everything. In 5th grade, he gave a school presentation on stock investing. And by age 10, he had bought his first stock and was regularly trading at age 12. He went to Cornell and got a degree in economics. And from there went to Harvard Business School. After business school, he founded Baupost, partnering with a professor from the school. Now, Seth is essentially a value investor. And you'll know good value too if you buy his book for only $1,000 something. That is how much the book costs. In it, he describes his approach to value investing, an approach which relies heavily on the notion of the margin of safety, which is in reference to the differential between the intrinsic value of an asset and the price paid for it. The idea being that in the worst case scenario for investment, there will still be that fundamental asset value. And if an investor buys an asset at an appropriate price close to that intrinsic value, then there is a margin of safety in that. If something is overinflated in price, and then it sinks back down to a more reasonable level, well then that could be a major loss. But if an investor bought it closer to the intrinsic value, and it settles down, well, there's a margin of safety there, because the asset is not as inflated. In 2008, he saw a large opportunity for value investing. He bought a large amount of distressed bonds and securities. At this time, most people were panicking and selling, but he, using that margin of safety approach, believed that he was getting the opportunity to buy those assets at a good price. He has described value investing as a matter of patience, and he's a highly contrarian investor. Like in the case of 2008, you will often see him going in a very different direction than the rest of the market. He described value investing as intellectually elegant. And he's really interesting because he is an enormously successful hedge fund investor who really does rely on those very foundational, old value investing rules. And he's an example of how much patience is required in order to do so successfully, and the amount of conviction and contrarianism that's required. Also, check out the price of his book. I was not kidding about that. Carl Icahn is a wild character. He was born in Brooklyn in 1936, and the guy who would go on to become one of the most famous brutal corporate raiders of history studied philosophy at Princeton. Not business, not finance, not economics, philosophy. And I think a lot more investors would get a lot out of it if they did study things like philosophy. After school, he became a broker at Dreyfus, and then later an options manager at Tessel Patrick & Co. And after this, he went to work at Gruntle. But ultimately, he went out on his own and bought a seat on the New York Stock Exchange, forming Ichan & Co. Originally, he focused on options and risk arbitrage. But not too long after, he saw another opportunity: corporate takeovers. He began with the appliance manufacturer Teppan. He began acquiring shares in an attempt to force the sale of the company to Electrolux. And from there, he found his strategy. He found enormous success doing what came to be referred to as corporate raiding. He would take a position in a company, try to get the board of directors to agree with him, and if they didn't, he'd buy up even more shares and force the company to do what he wanted. This could be sales, mergers, reorganizations, spin-offs, all sorts of things that he thought would unlock value. He eventually became such a feared figure in this regard that if the slightest news were around that Carl Icahn might be buying up shares, executives would panic. In one notable example, he acquired the majority position in Trans World Airlines, a company which he wanted to reorganize. The only problem is that there was a strike underway. But no problem, he simply talked to the workers and explained that he would gut the entire thing. Another time, he met with executives of a company that he was acquiring, and upon realizing he couldn't quite figure out what many of the workers were doing, he, and to quote him, fired 12 floors of people. But the thing that most scared management, the thing he targeted perhaps most heavily, was executive waste. He was not afraid to get rid of the entire C-suite of a company. He has made many attempts with variations of this strategy over decades, with companies like US Steel, Pan Am, Marvel Comics, Blockbuster, Time Warner. As of Q3 of this year, he holds his largest positions in CVR Energy, Southwest Gas, International Flavors and Fragrances, and his own company, Ichan Enterprises. Following a 2023 short report, the shares of Ichan Enterprises have dropped sharply. So, is this the end of the great and feared corporate raider? I don't know. He's an excellent businessman, and he is one of the most aggressive fighters on Wall Street. He's won fights and he's lost fights. But as a whole, I'd be pretty cautious of betting against him. If there's one thing you can say for sure about Carl Icahn, he does not back down.